The broadcast is now starting. All attendees are in listen-only mode.
Hey, good afternoon, everyone. This is Dan with Nadex. Real quick, just want to do a quick, hopefully we avoid some of the audio issues we had yesterday. So far, so good. We're just running a minute late here trying to finish up some last touches on this, and then we'll get going. If you just type in the question box if you can hear me all right. If not, I'll understand that we probably have... Okay, great. Give me one moment. You should be seeing a screen that has the Nadex homepage on it. And I'll be bringing up the presentation in just a moment, and then we'll get started. I don't know who was on yesterday. We had a bit of a mess actually with the audio portion of the thing, and it kept freezing up on me. So again, made some adjustments to the computer, and should have the presentation coming up here in just a moment. Thanks for joining us. Let me slide this out of here, and we'll get it to presentation mode. And today what we're going to be talking about is really the product breakdown of Nadex. We're going to be going through the product sets and looking and kind of just digging a bit into their structure and kind of going through that. I encourage everybody to ask questions as we go along. Want to keep this conversational. Don't want me just sitting here yapping at you for 20 minutes or so. So again, if you do have questions, type them into the box, and I'll do my best to answer all of them. My name is Dan Cook. I'm the Director of Business Development here at Nadex, and been at Nadex since 2011, but actually working with Nadex since 2008 on various projects, contract specs, different things like that. So you're in good hands. If there's a question you have about the contracts that I can't answer, I will certainly get you an answer, but I'll also be kind of shocked. I've spent a lot of the last decade studying these contracts as well as designing a lot of the aspects of them. So with that, we'll get going. And again, if you have questions, just stop me. Before we begin, quick risk disclosure as always. Obviously, trading involves risk, whether that be on Nadex or any other market where you choose to put real funds. When you're trading those funds, you can lose them. It's not appropriate for everyone. You need to make sure you're using risk capital. If you're using grocery money or anything that's otherwise allocated, it's just a surefire way to lose all of your money, right? You can't have that, if your next meal is depending on those funds, you're probably going to be too stressed psychologically to really trade effectively. So even if it takes a little bit longer, if you need to spend some more time in the demo, which is free, it's good for life, the markets will be here. And that's not just with Nadex, with any markets you're considering. I know we have a lot of people that have traded forex on here, stocks. Always take your time. One quick thing, I'll touch on that in just a minute, but got to get through this risk disclosure, then we'll get going on the presentation, right? We also have to take responsibility for our trades. And if you are trading in demo, there are some differences in pricing, right? The market makers that are pricing on demo are the same ones that are pricing live, but they're not adjusting their prices to time of day like they are in the live market. So start small. You don't have to jump in with your entire account. Give it some time. Build up the account. Don't try to just double up. Again, that's surefire way for success or for losses to ensure that you're not successful. Also on this presentation, this is owned by and copywritten by Nadex, the North American Derivatives Exchange. Please don't record it, reproduce it, republish it, or distribute it without our permission. If you do want the permission to do that, if it is something you'd like to reproduce, just reach out to us. I'll give you the contact information at the end of the presentation. Shoot us an email, and we're happy to talk about it. Just don't do it without our permission. That comes from our legal department. Alrighty, with that, and before we get into the products and understandings, we always like to talk a little bit about trading. And this is one that kind of resounded with me. I always draw parallels in life to trading. I've been trading a long time now, and almost every decision I make is what's the risk, what's the reward. I look at it that way. But as far as I kind of in the disclaimer talked a little bit about, you don't have to jump right in. I've seen it a lot of times with traders. I've spent the last, 14, 15, 16 years working with individuals as a trading coach, as a mentor. And I've had a lot of experience. And one of the benefits that I've had both at working at brokerage firms as well as working here at the exchange, is getting to see a lot of patterns in people. And so the one I always like to compare, I don't know if anybody's ever watched The Simpsons, but what I see with a lot of times traders, particularly newer ones, two things. They get in, they deposit their funds, and then they just want to trade right away. They don't exhibit any patience or discipline. You have to have the patience and you have to have the discipline. When you're trading live, look for those setups. You don't want to overtrade. Cash is a position. Overtrading is a big downfall, right? Because we think, oh, hey, we've got to be trading. We're traders. That's what we do. We trade. And that's just not the case, right? Look for your opportunity to spot those. And I mentioned The Simpsons because there was one that just always pops into my head every once in a while when I'm talking about this aspect, is that when people first deposit their funds, the first thing they want to do is place a trade, right? It's just natural habit, right? We've got the money there. We want to place the trade. But there was a Simpsons where Homer went in and he was going to buy a handgun. And so he fills out all the paperwork and stuff and gives the guy his money. And the guy looks at him and says, okay, great, you can pick it up in 48 hours. And Homer's comment was, 48 hours, but I'm mad now, right? We don't want that type of attitude when we're trading, right? We don't want to be overly aggressive thinking, hey, I have to trade right now, because you don't. The markets will be there today, tomorrow. For the rest of our lives, there will be a market to trade. So just something to keep in mind. I always like to throw in a little bit of things that I've seen over the years as far as mistakes traders make and things to avoid. So let's get started with the presentation. We're going to be talking about how the contracts actually work. How do they function? You know, when we look at a binary option, we look at a touch bracket, we look at a call spread. And each one actually has its own benefits, perhaps drawbacks, depending on how you're looking at it. But you can trade them situationally, right? You don't just have to be a binary option trader. You could actually trade binary options and touch brackets depending on the situation in the market. We're going to cover that today. So let's get started with binary options. A binary option is really a simple yes or no question. You know, will this market be above this price at this time, right? If you're a buyer and the answer to that question is yes, you receive the payout, right? If you're a seller and the answer to that question is yes, then you receive nothing, right? It's all or nothing at expiration. Now I'm going to talk a little bit more about that as well, because I want you to understand how to trade in and out of these. We talked a little bit about it yesterday if you joined us. These are all or nothing, right? If you're a seller, you're hoping that that answer is false, right? It's a no. The market will not be greater than that. So for example, here we have the Wall Street 30 greater than 26,110 at 4:15 p.m. So right, that's our question. Will the Wall Street 30, which is based on the E-mini Dow, be greater than this price level at this date and time, right? The pricing of a binary option is really based on what the market thinks the probability of that event happening is, right? So in this case, and as you get to know binary options, the pricing becomes very intuitive. I can just look at this order ticket that's on the left-hand side, and I can tell you that the indicative price is it's already greater than 26,110. And if you can kind of see, it might be a little bit small on your screen, it's at 26,129.53. There's an hour and 38 minutes remaining in this contract, right? The reason I know, or I can tell without looking at the indicative, that it's definitely over that strike is because of the probability, right? If we look at the midpoint between the bid and offer, we're probably looking at about a 71% chance the market's saying that this event is going to happen, that this question is going to be a yes. When looking at the pricing of a binary option, it's always based on the statement as far as what is the probability of that being a yes. If we saw something priced, say, at a 27 bid 32 offer, right, we'd know it's below the strike price, right? Because the market's saying the probability of that event being a yes is much lower, right? And what we call at the money is typically when it's trading right around the strike price. Now there's multiple strike prices. And if you look at a strike chain, you'll see those strike prices referenced. And what you can see are all the probabilities. That's why there's multiple strikes. And you can do multiple strategies within those. One of the nice things about a binary option, you always have your defined risk. You have multiple choices available. So maybe sometimes you think the markets are going to be more volatile, right? In that case, if you think there's going to be a lot of volatility, say around a fundamental news announcement where there's a lot of great strategies for binary options, right? Because you can get those big moves, right? If you see this order ticket, say 67.50, and you're buying it at 74.75, and there's going to be a lot of volatility, you can do that, but you have to understand that the market can change pretty fast, right? If let's say there's a Fed decision and you're trading a currency contract, or maybe it's this one at the Wall Street 30 and it's the first Friday of the month and non-farm payroll is going to come out pretty soon, and you know that there could be a big market move, this might be a lot of risk to take. On the other hand, maybe if you're doing this particular trade, excuse me, on a random afternoon where the markets are barely moving and you're not expecting much volatility, and all you're doing is looking for time, right? Because even if the market doesn't move here, slowly that contract either has to go to 0 or 100, and it's above the strike price. If the market's already above, right, the market can either go higher, in which case you're still in the money. The market can stay the same and go into expiration, in which case it closes at 100. Or even if the market drops, right now it's at 26,129 when we're looking at this, provided it drops but still stays above the 26,110 level at expiration, that contract is going to settle at 100, right? So you might have a slow market where we call it time value, where you're just looking for that time value to expire. And what happens is time value expires in a market that doesn't move. Contracts that are already in the money stay in the money and slowly go higher up to 100. Contracts that are out of the money or below the 50 level slowly go to 0. People call that premium collections. In more of an option strategy, you're just looking for the effective time to take it to 0 or 100. Now, if you're looking at, say, again, a volatile market, something that could be coming up, maybe it's a fundamental release. There's quite a few big ones every month. That might be the time where you're looking and saying, you know what? I want a lower probability trade. I want lower probability of it being yes, so I have to put up less capital, right? So for example, in this example, if I put up $72 to buy this contract, my maximum loss is 72 with a maximum profit potential of 28, not inclusive of the $1 exchange fees, right? But if I'm expecting a big move, maybe I try to buy a contract at 20. Now again, and this is where I don't really like calling them all or nothing. They're all or nothing at expiration. But a great way to trade a binary option contract is you're just looking for movement in the market. The general rule of thumb, if there's time remaining, now as you get close to expiration, it can get pretty big moves in the price of the binary option because the difference between one tick could be the difference between all or nothing. But if you've got time remaining, like in this case, we've got an hour and 38 minutes remaining. If we've got the market right at 26,110, right, we might see something priced right around a midpoint of 50. Maybe we have a bid offer of 48.52 or 47.52, right? So if I buy that contract expecting volatility at like 20, I'm putting up $20 with a maximum profit potential to make 80, right? But I don't have to wait for that 100, right? It's a low probability trade of it hitting 100. But if I get that move and the market goes up to 26,110, it's got to be trading somewhere around 50 just by the way these are priced. So I can take my profit, and that's really important, right? If I buy it at 20, the probability of it hitting 100 is not that great. But if it makes a 30-point move, what's wrong with taking 1.5 times on your profit, right? Or if you trade multiple contracts, let's say you trade 5 contracts, you bought at 20, if it goes up to say 48 or 50, you could close 3 of those out and see if the market really runs. Again, though, if you buy at 20 and the market starts to drop against you, you know, in a fundamental situation, it might be tough to get out, right? If you get a big, quick market move against you and takes you basically all the way down to the maximum loss. But if it comes out and nothing really happens and didn't do what you expected, and maybe you can close that trade at $10 and you can take a smaller loss. So always keep that in mind when you're trading binary options. You don't have to take the all or nothing when it comes to trading them. Very important point, and one I've been preaching for years and years and years and really want people to understand. Right? So that's the basics really of a binary option and their functionality. They're going to move in pretty much, they're not linear with the market. I'll touch on one other thing, right? As I mentioned sort of, and I want to explain that concept, even if this market doesn't move, right, this is going to go to 100. From 67.50 by 74.75, if the market doesn't move at all, by expiration, that's going to go to 100. So even though the market didn't move, the binary option increased in value. And so that's something important to understand, right? They're not linear. They're not moving in lockstep with each other. Similarly, when you're looking at close to expiration, you can see the difference between just a couple of ticks. Like let's say you're 1 minute out on a binary option, right? You're maybe only expecting a couple ticks move in that minute. But if it's right there on the strike price, you can see that go from 80 to 20 to 90 to 5. So always understand that when you're looking at, pricing binary options. I'm going to show you where you can get some additional resources as well on these. Excuse me. I didn't mean to cough in everyone's ear. Touch brackets. This is the newest contract. We launched those last year. We are going to be looking to expand this contract. This is the most similar contract if you've traded futures or forex before. It's basically the equivalent of a micro futures contract on the indices or a mini forex contract when you look at the per point value. So again, we have the Wall Street 30. Here we see a range, right? So basically, this is not asking a question. This is not an all or nothing contract, such as a binary option. This is actually what's called a variable payout contract with a knockout feature. So here we have a range. This range is 26,030 to 26,530. Now in the example of this contract, it's a $500 total value contract. The whole range is worth $500. So as you can see in that grid in the middle, the floor is 2630. The ceiling is 26,530. Right? So if I'm long, if I'm buying, if I think the market's going to go up, my worst case scenario is that the market drops, it hits 2630. If it does, that contract gets knocked out. It's automatically expired at that price. Similarly, if I buy at 26,130 and the market makes a quick move up and goes to 26,530, that's going to lock in my profit. So when you're buying, the floor is your maximum risk, the ceiling is your maximum profit potential. Right? So in this case, buying at 26,130, my maximum loss would be 100, my maximum profit would be 400. If I'm selling, the ceiling is my maximum risk, the floor is my maximum profit potential. All of these contracts have a maximum duration of 1 week, right? And they can settle a couple of different ways. So we talked about if they're touched, right? If they're knocked out, we'll say, then that contract is going to be expired and a new contract is going to be immediately listed. And we'll take a look at how that works in just a moment, right? These are only offered by Nadex. The way they're variable payout, and again, I'm going to encourage you with all Nadex contracts, you can close out early. So for example, if I buy this contract at 26,130 and it's $100 a point on this contract, let's say it drops to 26,090, so it dropped 40 points. If I've determined that I'm wrong, that my analysis is incorrect and it's not going to go in my favor, I can close this trade out, right? Why take a loss of 100 or potentially take a loss of 100 if I was wrong, right? If I determined that the analysis that I put in did not work and I'm wrong, I can get out with a much smaller loss. Similarly, if I buy at 26,130 and the market goes up to 26,330 and it looks like it's about the end of the run, I can close out and lock in my profit, right? So we're not looking necessarily for all or nothing, particularly on a contract this size. And if we're trading multiple contracts, we can always scale in or scale out. So for example, if we scale out, what I mean by that is if I buy at 26,130, and let's say I traded 5 contracts, I've got $100 risk. If it goes to 26,230, right, I could close out 3 of those 5 contracts. I can close out a partial position. That would lock in $300 profit. Now, if it all of a sudden makes a big drop down to 26,030, I've already locked in profit, right? 300 contracts I made $100 on. 2 contracts I lost $100 on. That'd be $100 profit. Not again inclusive of exchange fees. But if it goes to 26,230 and I lock in 3 contracts and then it goes to 26,330, maybe I take another one off, right? And then maybe it goes to 26,430, and then maybe I let the other one see if it runs and actually knocks out of the profit or at the maximum profit. So they're very flexible in that respect. They're very much like trading the underlying market. One of the things that I really like about this is that they actually have a built-in plan for each trade, right? Now, you should still follow your trading plan. You should have an entry and an exit plan for every trade and an exit on both sides. And this was one of the things that I saw really over the years that really hurt traders a lot on both sides. On the downside, they would place a trade and they'd put in a stop. And then all of a sudden, or they'd put in a mental stop, which is the worst, right? Because as the market moves, they're going to say, oh, my mental stop keeps moving with it. Or I'd watch them. I could look at the order monitor and they put in a stop and then the market's getting close to the stop and they start moving it farther and farther and taking on more risk. On the profit side, they might get a really nice move up and they're thinking, oh man, I'm going to be greedy. This one's going to be a slammer. It's going to run. It's going to run. And then all of a sudden the market reverses. And now they're back at their entry price or worse, right? And so they didn't have a plan to take profit. So because you have these maximum boundaries, we often say they have discipline when you don't. So they're a great starting point. And you actually get really high effective leverage with these contracts. Now, at the end of the week, the nice thing is also, if you've traded futures before, you understand about initial margin versus maintenance margin if you're going to be holding it overnight. The collateral required to hold these never changes. It never changes. If you get into a trade at 1 p.m. on a Monday and that contract is still going on Wednesday, your initial deposit never changes. So let's take a look at how these are structured. And again, I say to everybody, trade these in the demo first, right? So if we accidentally flip my page here. So at the beginning of each week, right, we're going to see 4 contracts, right? We'll have 4 brackets listed. The way these are structured is we wanted to create a contract where if you were going to be long, you had a close floor where you could mitigate your risk yet have plenty of potential upside. If you were going to be short, right, you might want to choose contract 4 where the ceiling is closest to the underlying market, right? Because that'll mitigate your risk and still give you big potential. Now, technically, you could take both of those contracts. I definitely don't necessarily always recommend that because, right, if one gets knocked out and then it reverses, you could take losses on both. But there's different strategies you can implement. Something else to consider. So, for example, let's say I buy contract 1 here. This green line represents where the market's at. Let's say the market drops and I have a contractual stop. There's no slippage on these. It's going to settle right at that level. So even in really volatile markets, you're never going to get slipped or lose more than you expect, which is huge. After spending years in the currency market, I saw that happen to plenty of people. If the floor of number 1 gets knocked out, a new bracket, we'll call it number 5, is going to be created right, just down from number 4, where the underlying market is now the ceiling, right? And if it continues to drop and knock out contracts, it'll continue down in a stair-step fashion. If it's knocking them out on the way up, they'll go in an upward stair-step fashion. Something to consider with these as well. Well, often we look for a floor if we're buying that's close to the underlying market. Let's say that we get in here on contract, we're not even in yet, but the market's down and it drops and it's really close to the floor of the contract. Even though we can get a really cheap trade, we may want to actually go for the other bracket that takes on a little bit more risk, but still has great potential return, just so we don't get knocked out too quickly, right? We want to understand the flow of the market and how those work. So that's really a high-level overview on touch brackets. Call spreads, and actually I think these are one of our better contracts. I often heard, actually one of our educators often says, binary options are easy to learn and hard to master, whereas call spreads are a little bit more difficult to learn, but much easier to master, right? A call spread is also a variable payout contract. It's not all or nothing. You never get knocked out like in a touch bracket. The way these work, and this is what's unique about them, they actually, if you're interested in learning options, These these are a great way to start learning the impact of what we call optionality on contracts and how you're basically buying time to be right. I don't know if anybody on the call here has ever traded forex or futures. If you have, then you probably understand the number of times that's happened to all traders where where you get into a trade, it looks like the perfect trade, and then let's say you bought and you have your stop there, and all of a sudden the market runs down, it stops you out, you're out of the trade for a loss, and then all of a sudden the market takes off in what would have been your favor, right? You had the right indication on where the market was going to go, but it was just mistimed. With a call spread, you're buying time to be right. It looks like I'm experiencing a little bit of degraded audio. I was hoping we were avoiding that. We were doing pretty well up till then. Hopefully I'm back. If anybody could let me know if we're back and sounding good. Okay, cool. Thank you. Right, and so you can get stopped out a lot. The great thing about a call spread is you pay a little bit of optionality. So for example, if you're trading, and again, the floor, if you're buying, is your maximum risk. The ceiling is your maximum profit potential, and that's if you're buying. If you're selling, the ceiling is your maximum risk. The floor is your maximum profit potential. Again, you can close out any time. You don't have to take the maximum losses. You know, you can lock in profits or you can take smaller losses. What's really cool about this is, let's say that we were trading this contract. And just to give an example of optionality. So let's say this is our floor, 26,100. Here we can see in this example, the indicative price is at 21.66, roughly, right? In this case, we might be buying at 26,170. So your first question may be, well, why, if the market's at 26,166, am I buying above the market, right? I'm at a little bit of a disadvantage. That's optionality. You're basically paying a premium for the time to be right, right? In this case, it's 4 points or $4. The reason, and the closer to the floor it is, and the closer to the ceiling, if you're selling, you'll probably pay a little bit more optionality, right? But the reason people are willing to do this is, let's say that I get in early in the day, and the market's sitting here, and all of a sudden the market goes from 21.66 and drops down to 26,080, right? It's below my floor, right? If it stays there, I'm taking my maximum loss, right? But I'm never out of the trade until it expires. So if all of a sudden the market goes from 26,080 or 090 and rebounds and goes past 26,170, I can still make money on that trade. I'm never stopped out. Looking at the shorter term ones, and we'll show how they're structured in a second, that can be a really attractive benefit for paying a little bit of premium. Now, the more volatility that's in the market and the more time, the higher premium you pay, right? If you think about it, like if you have, you know, a lot of people say they don't use options, but if you have car insurance, you're basically using an option, right? You're paying a premium for that protection. You're not paying the full value of your car each time, but you're paying a premium to protect that investment, right? Now, this is a position, and you're paying that premium to protect it. Now, if somebody said, okay, I'll insure your car for the next 6 months at this premium, right? Let's say it's $100 for your next 6 months. It's probably ridiculously low for the cost these days, but let's say that's your premium for the next 6 months. Now, let's say you want to insure this car for the next 5 years. Do you think they would still charge you $100? No, right? They'd probably multiply it out, and you'd probably end up paying something like, you know, $1,000 in premium for that 5-year protection. Same thing with these and with options. The more time you have, the more premium you pay. In the same example, let's say you're a really good driver. And so in 6 months, right, you're going to pay that $100 premium versus somebody who's a really bad driver. We'll call that a volatile market, right? For that same 6-month period, they might pay $200 in premium, right? Double. Same thing with the market. The more time remaining and the higher the volatility, the higher the premium is going to be. You know, that could be $1 or $2, it could be $8 or $10. All depends on what the markets are doing. Hopefully that analogy made a little bit of sense. when we're looking at time or when we're looking at volatility. Calm market, good driver. Volatile market, somebody who's probably been in a lot of accidents, right? They're going to pay more. And so that's what's really cool about these contracts, is that you can actually get in and you're buying time to be right. Now, at expiration, and the reason these are considered variable payout contracts, I'll walk through how expiration works. So we bought this at 26,170. Let's say that at expiration, the market is at 26,130, right? That's where it expires, right? We lost $40. We lost the difference between where we bought and where the market settled. Now let's say we bought at 26,170 and the market goes to 26,270. Okay, in that case we made 100 points, or $100 a contract in this case. That's what our return on this particular trade is going to be. Wherever you bought or sold to the expiration is going to determine your overall profit or loss at expiration. And if the market, let's say at expiration, you bought at 26,170 and the market is at 26,070, your maximum loss is still only to the floor, right? Similarly, if you bought at 26,170 and the market is at 26,570, your maximum profit or settlement value will be 26,500, right? It can never go beyond those ranges. So the way these are structured, and depending on the market, they're structured a little bit different, right? We design everything for the type of underlying market. So in this case, we may have daily spreads, which are really wide. You'd see it here in yellow. And this is the market at 8 a.m. Whoops, right? And then we have intraday contracts, right? And we'll have overlapping ranges. So you'll have where price is in the middle of the range, and then a floor to a ceiling, and then a ceiling to a floor. Then we'll even have shorter term 2-hour contracts with the same premise. The reason we do this is we want to be able to keep risk low without getting stopped out, but still have an opportunity, even if we pay a little bit of optionality, still have a good opportunity to profit. And in some cases, traders will actually do both things. For example, if we look at this 8-hour contract, they'll buy this one, right? They'll pay a little bit of optionality towards the floor, and they'll sell this one. So let's say I'm paying 10 points here to buy this one, and I'm selling this one at 10 points, right? I've got 20 points total risk. But if I've got a market that moves on average 80 points, I might be willing to take that and give up a little bit of edge. If you put limit orders on that, that's basically the equivalent of an options butterfly strategy. And the same thing with the 2 hours, right? Now, as the market moves up, right? So if the market moves higher, right? When we launch our next 2-hour contracts, we're going to do the same configuration, only at wherever the current market level is. And that's a bit on how these are structured. Again, I recommend that you check all of these things out in the demo account first. The demo pricing, as I mentioned at the beginning of this, will be a little bit different, particularly on binary options, only because of their susceptibility to time of day and volatility, right? Time, volatility are priced really into the call spreads as well as the binary options contracts. Not so much the touch brackets, because they move very linear with the actual underlying indicative market. But take a look at them and you'll start to see how they move, right? A demo account will never teach you how to trade. Only putting real money in a real market will. But again, we encourage you to start small on that. Start slow and small, and learn to be consistent. That's the main thing. Don't trade the demo account and ever think that, hey, if I was hugely profitable in the demo account, I'm going to be profitable in the live account. The psychological factors are just totally different. And don't start with your full account, right? What you'll do is start small, maintain good risk parameters. And let's see, if you were to choose, I got a question here. If you were to choose instruments group to trade, what would you choose and why? That's a great question, because these are all like pretty situational in my mind. And it could be around a different variable time. If let's say I want to trade around a fundamental news announcement, I think doing a strategy, and I'm actually writing a piece on it right now called a binary option strangle, where you take both sides of the market. What you're looking for is a low risk, high potential return type trade. So if I was looking for a binary option in that, I would probably, or if, like a fundamental announcement, like particularly if you got like a Fed decision, something like that. I think binary options are great. I also think in very slow markets, right, a binary option is a great instrument. So, for instance, when we were talking before, and I'll flip back to the binary option slide, right? So, for example, let's say again it's a random afternoon, and I think that nothing's going to happen in the market, right? Now, I always want to be a little bit of aware because I don't want a quick move to take me out of everything. I want to be able to close out if it starts moving against me too much. But let's say I place this trade. In a slow market, this is what's called premium collection. It's a little bit different than in the traditional options world. But basically, if I buy this, in this case, the ticket was $72, right? I'm expecting not a lot of market movement. So I think that by virtue of time, uh, that this is just going to go and it's going to complete at 100. I'm willing to put up more risk than my potential return because I think the probabilities are so far in my favor, particularly if the market's already over that and I've got what I feel is a strong level of support, right? So two places I think binary options really make a lot of sense. And we have people that trade them, throughout the day and throughout the evening all the time, right? And also particularly on the short term contracts, maybe you've only got an hour a day to trade, so something like a short term binary option would be a good thing. So when I'm expecting something like a news announcement, binary options I think there's some great strategies, and there's strategies for any of these contracts around then. Um, the thing I don't necessarily like about a touch bracket, if I'm coming into a news announcement, is just the possibility that a quick move like smacks the contract out for a loss because I'm closer. Like if I was buying, I'm closer to the floor, or if I was selling, I'm closer to the ceiling. So I think a binary option strangle strategy, or when the markets are really slow, like there's nothing going on, it's like watching paint drying. That's often the day before a fundamental news announcement, or even the morning before something like a big news announcement. Like let's say it's 8 a.m. on a Wednesday and there's a Fed decision that afternoon. In the actual underlying markets, as you'd presume, even institutions don't necessarily want to be overweight long or short. And so you really see markets slow down at that. And so what I'll see is a lot of people do this basic like premium collection strategy. So again, on binary options, volatile news announcements or very slow markets, maybe in a random afternoon or in the evening when the contracts aren't really moving that much, I think binary options are great. If I'm looking for something more like uh, um, where I've got a really solid trade that I think is a setup, but I could see a breakout or a quick break. I'll call it a fake break. I like the call spreads, right? Because you're not going to get stopped out, but you can still get that short-term movement on the daily. You're also, because they're only a day, you're paying a little bit less premium than what you would on a weekly option. Um, there are also some strategies on the call spreads that I really like. Like let's say we just have normal market conditions. All right, we're expecting just the average daily range to hold true. We just don't know which direction. It's been kind of all over the place. I like kind of doing that. And by the way, when I say I kind of like, I'm not allowed to trade Nadex live. I'll make that disclosure. Ever since I came to Nadex, right, I have to be unbiased as an exchange. We as an exchange, nor any of the employees are allowed to participate in our markets because we have to remain unbiased. But a lot of these strategies I designed before I was at Nadex and have worked with a lot of traders since. So just want to clarify that. So if I'm looking for normal movement, but I don't really have a good sense of direction as far as where it's going to be, I like doing it would be kind of like a straddle or a butterfly using a call spread. If I've got a market then where I'm looking for linearity trading day, I could also use a touch bracket in that, particularly if I want to hold it overnight, if I was trading futures and forex, because it's going to be very linear. And I think the touch bracket is actually a great first step for people that have traded futures currencies because they're very intuitive to what you've seen before. Maybe I've got a little bit longer term trade setting up because the touch bracket is a week. I'm not looking for it all in a very short time. Does that make sense, Joe? One of the things, and just to let everybody know, one of the things we're doing is actually redesigning the entire education center here. We've got some good material out there, but um, in my opinion, it's difficult to find exactly what you're looking for. And so what we're creating and hopefully be launching here in December is a new education center, which, gives you a clear path, right? If you're new to trading and Nadex, we want you to have information um, that not only explains Nadex contracts, but also talks about things like market psychology. How do you build your trading plan, right? These are essentials for traders to know. How do you manage risk? Very important. And as you may or may not know, I mean, the way Nadex makes money, right? We collect an exchange fee on every trade, right? It's in our best interest to give everybody their best shot at success, right? Because the more successful you are, the longer you can stay around, the more money we can make, right? It's good for everybody. It's one of those few instances in life where you can really find a great win-win by helping people out. Actually, I guess just helping people out in its own should be its own reward, as my mother would say. Um, let's see. Any plans? Any plans to offer trailing stops? Yes, actually. So we've been speccing them out. We've been looking at uh, basically bringing on those. I don't have a set time frame on those. We are launching we've already put it in beta, the new platform. So we will be looking at adding those stops. Those are a little bit, we've got to add a lot of functionality to the beta um, uh, before we'd even be calling it really a live, but it's in a beta test because we want people's feedback. But we will be looking at just adding stops in general. And one of the reasons why it's actually taken a while is because forever binary options were about, 95% of our volume constantly. And stops on a binary option have always been a little bit tougher just because of the volatility towards expiration and how do we implement those? And are they actually good? Because binary options can actually skip prices a lot. Where we don't see that, like what I mean by skip prices is um, you you buy at 75, put a stop in at 60. If it's close to expiration, right, you can actually see that contract, if it's close to the strike price, go from 70 to 40. And where does the stop get gets filled? It gets filled at 40. We've worked around a lot of those issues and doing a protection range on those. But with the linear contracts particularly, I think the stops are just an absolutely necessary thing, right? We all want to be able to sleep at night if we've got a trade on, and we want to put some modicum of protection in there. And also, if the market comes back, um, you know, if let's say we were in a touch bracket, right, and the market's going up, 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 and we were buying, right? We don't want to go to sleep and then all of a sudden give away all of our profits, right? And so that's we will be looking to add stops and trailing stops. Again, don't have a time frame, but it's in the works, and we've had a lot of meetings, a lot of discussions, a lot of tech and dev work and considerations going into those exactly how they should work. And I will say you'll see them in demo um, for probably a while before they go into our live markets. And the reason being is we take very seriously our obligation um, to fully test and vet everything where it's not going to cost anybody any real money, right? That's a serious obligation. We have an obligation to the integrity of our markets and to safeguarding our members and traders. And we take that very seriously. So you'll probably know when they're about a couple months out because you'll start seeing them in demo. And that'll probably be a month or so after we've tested them in our test environment and think we had all the bugs worked out. But so yeah, that's where we're at on that. We've got a lot of good stuff happening here. It's been a busy time. I've been here a long time, but I'll tell you this year, with all the things that we're getting accomplished, things that you haven't even seen yet, but are coming very soon, I'm very excited about. And then the thing I'm most excited about is that almost all of it, like we put together kind of the core framework, but then it's all been feedback from our members. And with that, I'm going to say, if you've got feedback on these webinars, if there's other different like titles or types of things that you want to hear, learn about, send an email to asknadex@nadex.com, right? And we'll do our best to get that created. It might take us a little bit of time because we are pretty busy, but it's certainly something we want to hear from you. If you say, hey, Dan, I want you to do a webinar on the binary option strangle, send us an email, asknadex@nadex.com. binary or spread butterfly, or really dig deeper into this, or hey, how do I build a trading plan? These are all things that we're putting together. And again, that's based on feedback. Where I hear the most feedback, that's going to be the priority, and that's how we operate around here. So we've got a great. I'm sorry, I really ran over on this webinar. Absolutely, I will run a binary option strangle webinar. It probably won't be this month, but I'll try to get one on the docket for December for that strategy. Because I do think it's a strategy that requires some understanding. But once you really get it down, I've shared it with a lot of people over the years. And obviously, I think it's great strategies. There's no guarantees. But I think with the low risk, high potential return, and if you understand if you're wrong, how to get out, then it is a pretty solid strategy. Again, when you have questions, give us a call. We've got 24-hour client support throughout all open market hours. Starts on Sunday afternoon. We've got people on the phones going all the way through Friday afternoon. Shagun, there will be a recording of this webinar sent out probably within a few hours. So everybody that registered will get a recording of this webinar. Thank you for reminding me, because I should have mentioned that at the beginning when we got started. But yeah, so you'll have a link. This was recorded, and it takes us a little bit of processing time, and then we have to, of course, have compliance check it out to make sure I didn't say anything unruly. I don't think I did. I don't know. Sometimes I go off on tangents just about trading because it's in my blood. But with that, if you have questions, reach out to our customer services. If it's something they can't answer, and Joe, did the recording from the alternative recording not go out yesterday? If not, I'll follow up on that. It should have been sent out to everybody that registered yesterday, but if not, I'll make sure that gets sent out ASAP, because that one's already been approved from a previous one that had the same content. Yeah, so I'll make sure that one gets sent out as well, and make sure you guys are all set. Definitely, again, give us feedback at asknadex@nadex.com. Hope you enjoyed this. I love speaking with everybody. A lot of great questions. Great group here today. And you know what? One thing I'll always say, one of the things I really love about these, and I've said this for years, I like the group setting, because a lot of times somebody will ask a question, particularly if you're newer, that you wouldn't even think to ask. And so it's important to take part in these things because you can just learn so much more. It accelerates the learning curve. So with that, I want to thank everybody, and hope you have a great rest of your day, evening, morning, whatever time it is from wherever in the world you're joining us. Talk to you tomorrow.